Amish Shah is with us. He's our market master of the day, head of India research at BofA Securities. Amish, good to have you back on the program. It's good to see you. Good morning, Prashant, this side. Bring in the global intel that BofA has and sort of shine it sharply on where we are at, Amish. The India market, which is, it's been terrible last few weeks now, right? Relentless selling from foreigners, and of course, all the news flow, etc. How are things looking? Let's just start at a broader level and then we'll drill it down to individual sectors, etc. Amish, you'll have to unmute yourself.
Prashant, I would say we are a part of that correction as well. We went bearish on the markets back in August last year. We are still not getting constructive. I think this is a year where Nifty is likely to deliver only a single-digit return. Which is more like making a fixed income kind of returns with equity risk, which is not something that we are getting excited about. Mid and small caps, we think, are still expensive, can continue to correct, and therefore one should expect even lower returns than Nifty, possibly even negative returns. So not in the bullish camp yet, as yet.
I should say, ouch. Straight off the bat, I thought you'd keep it for later. So still not changing your bearish view and expect single-digit returns, and mid caps and small caps may be actually lower from here. Is that what you're saying, Amish?
That's what we are saying.
Okay, got that. Now let me offer, and I'm sure clients also maybe offer pushback. I don't know, but at the margin, right? Some of the things are changing. 2 quarters, government spending has been very slow. That seems to be picking up. RBI is certainly easing. There is a marked shift, right, across, say, forex management, liquidity, rates, regulatory aspects, etc. Maybe we're reading too much into it, but it's a change. New dispensation or not. Don't these things at the margin make a difference? Will they not make a difference, Amish?
So Prashant, they do, or you are very right that sequentially, whatever you look at, whether it is capex growth, GDP growth, corporate earnings growth, everything is on a sequential basis likely to improve. But at the end of the day, despite this improvement, if we are going to see consensus cutting estimates, whether it is capex-focused sectors or GDP or corporate earnings, then I would argue that that is still a reason to stay bearish. Despite the sequential improvement. In other words, a large part of that sequential improvement is known and more than adequately still priced in.
So is this a valuation problem then? When we say that valuations are too high, it's also an indirect way of saying that earnings are not coming, right?
So Prashant, if we were to look at it arithmetically, think of it like this, that we will agree that India is currently in a cyclical down cycle or a growth moderation phase. And as a result, it is very hard currently to justify valuations higher than the long-term averages. Even after the correction in Nifty is still trading at 4% higher than long-term averages. So ideally, that 4%, should become zero. So you're talking about negative 4% from a valuation standpoint, and you probably put 10-12% of earnings compounding through this year. There you're talking about the single-digit returns that I spoke about. So it's a combination of earnings being weaker as well as valuation unlikely to be able to justify in the context of those weaker earnings.
Amish, let's get to the portfolio calls then you have. In August of last year, you had downgraded industrials. So names like ABB, Siemens, BHEL, Havells, and these stocks have corrected 30-40% from its recent peaks. Is the correction done, or do you think valuations are still expensive and there is more downside? At what point do you start turning constructive on industrials?
So Reema, unfortunately, still more downside. So to your point, back in August, we downgraded 13 out of 14 stocks that we cover within the industrial space straight from buys to sells. And that is predominantly my coverage getting into a sell rating. Despite the correction that we've seen so far we've been able to upgrade only one stock and that to a neutral. So I have 1 buy, 1 neutral, and 12 sell ratings or underperform ratings. So look, Reema, I think on capex, between FY21 to FY24, which was a phase of capex upcycle, the industry saw 20% order flow growth, and as a result saw anywhere between 20 to 30% earnings growth as margins improved, working capital cycle improved, and so on and so forth. Now we are arguing that the capex cycle growth is going to moderate to 13%, and as a result, these companies will be able to deliver only mid-teens kind of earnings growth, which is the adjustment that the markets needs to do, both in terms of earnings cuts and valuation multiple expansion. To your point, on the back of 30-40%, a large part of that is done, but we are not there yet. So still in the bearish camp on everything to do with capex, so not just industrials, but we are, as a result, also bearish on cement, steel, energy, power utilities, anything that concerns the capex cycle.
Okay, all right. Hi, Amish. Good to see you in. Well, you're sounding, quite cautious actually on the markets, to say the least. But there'll be a couple of sectors that you're positive on. I think the consumption pack, staples is something that you'll have liked. Give us the top 2-3 sectors that you'll are bullish on so we can liven things up a little bit.
Sure, Nigel. So, we are currently positive on rate-sensitive sectors, which is autos, real estate, some internet, some financials, and given that our views on markets are cautious, we are also defensively positioned in healthcare and telecom. On the consumption bit, look, getting into the budget, we did anticipate that there will be a demand stimulus. And as a result, we do like consumption stories, because the benefit of the subsidies to the lower income households and the benefit of tax cuts now to the middle income households is a positive. But that will trickle down slowly through the year in the form of monthly subsidy payments or the tax savings that you would have. Other way to also look at it is that $12 billion or 1 lakh crores of the tax stimulus that the government announced is a good news, but is only 30 basis points of GDP. It is also less than 1% of the India's retailing market. So can it lead to a broad-based growth and a very high spike in terms or a turnaround in the entire consumption basket? Not really. So we are more stock-specific, selective in liking the consumption theme. We are currently positive on jewelry, travel tourism, cigarettes. We are positive on autos, and then finally some of the staple names as well. So very selective within staples and discretionary. We are not broad brush positive on everything consumption yet.
No, got that, and point taken. So this is you mentioned one number. You said 4% more contraction in valuations, or did I get that right? Or were you talking about? Just wanted to clarify that earlier.
So Prashant, that was for Nifty. For Nifty to come to long-term averages, valuations for Nifty needs to correct by 4%. In the meantime, earnings compounds by 12% through this year. So if I'm looking at the mathematical way of looking at Nifty, then it will be -4 + 12 equal to possibly 8% returns for Nifty this year.
Okay.
What are your global counterparts talking about when it comes to FII flows? We've seen relentless FI selling. The ownership is at a decadal low now. And there is a possibility, the dollar's getting stronger. Perhaps the Fed doesn't cut this year in 2025. What's going to happen on the FII flows front, to your mind?
So, Reema, I think FII flow continues to stay weak, because, just think about it, that the 10-year bond yields in the US is about 4.5, 4.6%. That basically means that the hurdle rate of returns that you expect from emerging markets like India is about 15%, right? Because 4.5% you are getting risk-free dollar return. Add to that another 4-5% rupee depreciation that is widely expected. So that takes you to 9% rupee return, risk-free. And then you would expect 500-600 basis points of equity premium because of you wanting to take equity risk and not a safer asset like a bond. So 15% return, arguably, as I'm highlighting, 15% for the markets as a whole is difficult to justify. For some stocks, yes, but for the market as a whole, difficult to justify. Then why should why should the FII flows be positive India? They will continue to look for US treasuries, US equities. We do think that developed markets this year will outperform emerging markets, including India. And on the point of FII ownership being too low, I get that all the time from investors as well. But I would say that, investors will go where there are returns. Just because their ownership has come down, that is no reason why they will add up. So you can, so FIIs can always first scale back on their ownership, and as and when India gets attractive, they can always scale it back up.
All right. All we can do is do our bit, right? Keep the SIPs going. That's from a domestic liquidity standpoint. But let's focus on another theme that I think you're quite bullish on, which is the healthcare space. And overnight, you had some commentary that even if there are some reciprocal, tariffs, autos as well as, pharma could get some kind of a leeway, which is good news as well. Tell us, how do you all want to play this particular theme, the healthcare theme?
No, so absolutely. So healthcare actually fits in quite well. It is a defensive sector, so in a weaker market makes sense. It is obviously also inelastic demand. It is difficult to move supply chains, even from a tariff perspective, even if they want to look at it. So it adds up quite well. Valuations are not as rich in that space. And there are some of the cyclical stocks like generics. There are some structural themes like hospitals. So as a pack, we do like healthcare. It's an overweight in our portfolio as well.
Amish, I don't know if you or your global team has published anything with regards to the Trump-Modi meeting tonight and implications of reciprocal tariffs, etc. If you have, would love for you to share that with us. What's the how is the BofA team thinking about this?
Prashant, honestly, on that, we don't have a strong view. The general assumption is that India is too small a trading partner from a US perspective. And as a result, there isn't likely to be too much damage, but that's a hope. Clearly, even the markets are not pricing in too much risk yet from anything going wrong in terms of those discussions. So from my perspective, actually, it's a neutral to a negative event for the market.
Neutral to a negative event. For the market, any thoughts on the forex side here in India, dollar rupee, Amish?
Sure. So the view is that as RBI is now saying that they will let the currency play its own role. They are only going to look at very large swings like the way we saw a couple of days back where RBI intervened again. But otherwise, we do think that rupee depreciates. 88.5 is currently our house view. From a near-term perspective, and the 9% valuation of rupee, we think will only close in gradually over a couple of years' time, not immediately.
Any thoughts on sort of export sectors, pharma, IT? If you've sort of touched upon specifically IT, Amish.
So, Prashant, IT is the only sector where we are sitting on neutral weight, and we are basically telling investors that, just go and hug the benchmark. Because if you think about it, from a business momentum perspective, clearly the growth from the US tech spends is going to improve. So we can't complain. It's actually good news there. But at the same time, a lot of that excitement is already known. Earnings growth for IT sector, therefore, is expected to be 13% if you even include the rupee depreciation gains. And as a result, the valuations of these stocks are close to 28, 29 times 1 year forward PE multiples, which is not necessarily cheap. So on one hand, you have a good business momentum, but on the other hand, not comfortable valuations, which keeps us neutral weight. And that's the only neutral weight that we have in our portfolio right now.
All right, Amish, just to clear this point on the headline index, at best you get high single-digit returns for the year. At worst, what do we go down to in terms of to bring valuations at par or make it relatively attractive? Downside risk is something that will be closely monitored given the kind of headwinds that we're seeing, slowing economy, not that great growth. So on the downside, how much could we extend? Just on the headline index first.
So Nigel, I think downside risk principally is only external, which is the Trump tariffs, if I were to call it that way. That is the only key factor that I would watch out for. Most of the other factors, I would say, are domestic linked and is relatively easier to model. So we know that earnings growth expectation of consensus is high. We need to knock it down. Valuation expectations are high. We need to knock it down, and which is how we are arriving at that 8%, 9% kind of returns for Nifty. So I don't think minus something coming out of the Trump tariffs, I don't see too much of a downside risk as far as Nifty is concerned, because anything undershooting beyond that, we will get FII interest looking to buy India again. But on the mid and small cap side, I do think there are quite a lot of downside risks, because in a slowing growth environment, first of all, the large cap companies will try to gain market share from the mid and small cap companies, meaning obviously to shore up their growth. Secondly, from a positioning perspective, investors also will want to get more into large liquid names, from a capital protection perspective, so even that hurts. And otherwise, we have seen that, during market down cycles, margins and working capital cycle for mid cap, small cap companies typically deteriorates, which is not even priced in or expected in the earnings expectations of these stocks. So mid and small caps, I definitely worry, not so much for large caps really.
All right. Amish, good conversation today. Thank you very much for joining us. And it's a pleasure. And hope you come back again as we revisit these views if there's any change whatsoever, because, news flow is changing pretty fast out there. Not so much local, maybe local as well, but global definitely. Thanks indeed once again, Amish.